looking at another stock that's in the news today. It's Chevron, the second largest U.S. energy company, plans to sell its U.S. oil refinery and cut 2,000 jobs. Fadel Gheit, a veteran oil analyst and managing director of oil and gas research in Oppenheimer, he rates the stock a market perform. He joins us now to talk about Chevron. I should correct myself, it's the U.K. refinery that's being shut. Fadel, welcome. Is this the right move for Chevron to take? Because not just at Chevron, but really across the E&P space, those that have refinery businesses are suffering.
Correct. What we have seen in the last couple of years is that margin came down very sharply, and they are not likely to recover anytime soon, and the recovery is not likely to take them to, quote-unquote, the golden age of refining, which recently BP said it was a golden moment of refining created by almost a perfect storm of outages and demand growth and all this thing. It's over. So we are going to go back to the trading range in refining margin between $3 and $6, and that is not a great business to be in.
What do you think, or do you think that if more and more businesses start to get out of refining, how is that going to affect the prices of refined products, things like gasoline?
Very good question. Basically, the price of refined product will always reflect crude oil prices. Crude oil prices, in my view, are inflated, will continue to remain inflated. Right now, crude oil is selling at 18 times natural gas. The energy content is only 6-to-1, but the price is 18-to-1, which means that crude oil is 200% overvalued, if you will, compared to natural gas. Why? Because we have plenty of natural gas, and there is a perception out there that crude supply could be disrupted by Iraq, Iran, Nigeria, and all this. But having said that, that's a fact. That's a fact of life. We have to live with that. And that's why companies like Chevron is focusing more on crude oil, on production, less on natural gas, and less on the refining side of their business.
Right. And Fadel, you talked about a global view there. We're still seeing increasing international capacity. Do we also see that demand for refined products is still weak at this point?
Absolutely. Refined product demand in the U.S. and Europe has already peaked in 2007. It's likely to decline. The question is by how much? Is it 1% year decline or 0.5% year decline? Why? Because we are increasing the share of biofuel mandated by the U.S. government and by European government. So basically, there is no demand growth in the U.S. and Europe. The only demand growth is going to be coming from the developing world, China, India, the Middle East, and that will make up for the decline in the U.S. and Europe.
So, Fadel, just very quickly here, so you don't think Chevron is being a little premature here? You think this is going to be a more permanent shift? Oh,
absolutely. They are basically thinking that margin will be flat for at least 2 more years, and nobody really knows, because their forecast is that the 4 million barrels of excess refining capacity will be here to stay, unless we see forced closure, which is not happening yet, because every refining company wants the other refiners to blink, but nobody is blinking so far.
So do you think this is going to happen with other companies like Chevron that have a refining business? You know, we saw it with Exxon, we saw it with some of the other big E&P companies, that the refining really dragged them down.
Oh, absolutely. Royal Dutch Shell, the second largest refining company in the world, announced that they are going to dispose of 15% of their refining capacity, which is almost 1 million barrels per day.